Mortgage rates and inflation. Inflation, the arch enemy of mortgage interest rates, has been relentless over the last several years. But with the most recent PCE data, we're seeing a dramatic shift. Inflation has been retreating, and mortgage rates, well, they're starting to win that battle. But here's the real question. How low will they actually go? Could we see mortgage rates dip into the low fives or even below into the fours by the time we reach 2026? Imagine what that can mean for the housing market. Buyers who have been holding off are starting to jump back in. But if this newfound excitement drives housing prices even higher, what about inflation? Does that sneak its ugly head back in? Let's look at some data and insights. Hear me out as to why I think we will see mortgage interest rates start with a 4%. Over the last 2 months, mortgage rates have been on a slow, steady decline. We've gone from a near 8% in the highs in October 2023 down to around 6.25%. But let's be clear, this isn't happening overnight. It's been a grind, one small step at a time. So what's driving this? Inflation has been retreating, and as inflation backs off, mortgage rates are pushing back. The Federal Reserve has played a major role in this, holding off any future rate hikes and now forecasting hikes for the rest of 2024 and through 2025. These anticipated cuts are building momentum in the mortgage-backed security market. Investors are positioning themselves for a future where rates will be lower. The market is reacting, and we're seeing the early effects in the mortgage industry today. But here's the thing. This is only the beginning. As inflation continues to trend down, we're getting more and more support for those lower rates. This is why we're seeing such an uptick in mortgage refinancing. Homeowners are jumping at the opportunity to lock into lower rates, and pre-approvals, well, they're starting to climb again as well. After months of stagnation, buyers are coming off the sidelines and getting ready to view houses. Even with the typical seasonal slowdown we usually see in late summer months, more buyers are showing up. August and September are traditionally quiet months, but that isn't the case this year. People are feeling the shift. They're eager to move before rates drop even further and the competition heats up. Let's talk about the spread between mortgage interest rates and the 10-year Treasury. This is a key factor in understanding where mortgage rates could be headed. Back in late October 2023, the spread between the 10-year Treasury and mortgage rates was sitting at a staggering 2.92% or 292 basis points. Now, to put that into context, the historical average spread is usually 175 basis points. That is a significant difference. Fast forward to today, and we're looking at a spread closer to 250 basis points. If that spread were to normalize to its historic average, mortgage rates could easily be 3/4 of a point lower. That would put us near the magic 5.5 range, a game changer for anyone looking to buy or refinance. So why did this spread widen so much in the first place? Well, there are a few reasons. First, the Fed stopped purchasing mortgage-backed securities, which pulled a lot of support out of the market. In fact, they've been a net seller of assets, adding pressure to the rates. Second, higher interest rates meant that servicers, the companies that actually collect your mortgage payments and make your escrow payments, your taxes and insurance, they wanted a bigger premium up front. Why? Because higher interest rates meant that the borrowers are more likely to refinance out of those higher rates when the rates drop. It takes about 3 years for a servicer to start actually making any money on their investment on the loan they're servicing. So this demanded a higher premium to offset the risk of refinancing. But here's where things really get interesting. Fannie Mae, Mortgage Bankers Association, and even Wells Fargo are all predicting that the spread will start to normalize. We could see it range from 180 basis points to 215 basis points above the 10-year Treasury. And if that happens, coupled with a potential drop in the 10-year Treasury yield itself, mortgage rates could fall even further. Add in a slowdown in refinancing demand as more people lock into lower rates, and we're looking at the perfect storm for lower mortgage interest rates. So where does that leave us? The stage is set for mortgage rates to push even lower. We're watching the 10-year Treasury, we're watching the Fed, and the next move could mean big savings for buyers and refinancers alike. The window of opportunity may be opening sooner than you think. The Federal Reserve just dropped the overnight lending rate in September, a rate cut that wasn't just another blip on the economic radar, but it was really the most anticipated financial move in years. This isn't just a minor adjustment, it's the beginning of a rate cut cycle or easy monetary policy that could redefine our economic landscape through 2026. Chairman Jerome Powell laid out a clear roadmap in his recent speech, signaling that the Fed will continue to cut those interest rates over the next 2 years. Unless a seismic event forces their hand, this path is set. So, what does this mean for you? Lower mortgage rates and overall lower borrowing costs sound appealing, but how will this impact the housing market, inflation, and your ability to buy or refinance a home? While everybody is distracted by the surface level news, the real story, it lies beneath. All right, let's address the elephant in the room, the so-called impending housing market crash. Looking at the chart, does this look like a crash to you? Despite the sensationalist claims, the data tells a different story. Yes, the median home prices dipped slightly from July to August, but guess what? This happens almost every single year due to seasonality. Over the past 5 years, home prices have actually surged by 46%, with another 3.1% increase just this past year. The minor month-to-month decline is a seasonal hiccup, not a sign of collapse. I do mortgages across the country, and we have seen quite an uptick on refinancing. Part of refinancing requires a valuation of the subject property, which can be a full appraisal, a drive-by appraisal, or an automated appraisal. In certain markets, especially those that have bought in the last, call it 18, 24 months, have seen some depreciation, no doubt about it. As you know, real estate is very local, and some have seen appreciation greater than the national average, and some have seen less. That's the way it works. But stepping back and looking at the graph, you will see on a national level, there is no crash in sight. Every industry has its seasons, and real estate is no exception. As summer turns to fall, the frenzy of home buying naturally cools down. Families are settled before the school year, and fewer people are looking to move during the colder months. This is a very predictable pattern that explains the recent dip in home prices, not an impending disaster. The Federal Reserve's recent half-point cut isn't just a minor adjustment. It's a financial game changer that's already rippling through the economy. Mortgage interest rates have plummeted to 6.125, ahead of the most anticipated cut, the lowest we've seen in 2 years. In fact, this time last year, we were just below 8%. Remember, in his speech, Chairman Powell didn't just announce a one-time cut. He laid out a clear roadmap for the continued reductions over the next 2 years, again, barring any unforeseen events that could alter their course. This isn't speculation. This is the plan that is set in motion. So, what does this mean for you? The projections are that mortgage rates could dip into the 5% range in the coming months and into next year. This move in mortgage interest rate will save you tens of thousands of dollars over the life of your loan and hundreds of dollars a month. Lower rates mean lower monthly payments, increased buying power, and the opportunity to get more house for your money. The Fed rate cuts are your head start, but the competition will absolutely catch up. Acting now puts you miles ahead of the housing market. FHFA wrote a working paper about how supply will be strained into 2030 and beyond due to the lock-in effect of those sitting below 5%. This bodes well for appreciation. It's simple supply and demand. With more rate cuts on the horizon, the potential to lock into historically low mortgage rates is not just a possibility, it's becoming a rapid reality. This bodes well for appreciation. With more rate cuts on the horizon, the potential to lock in a historically low mortgage rate is not just a possibility, it's rapidly becoming a reality. Now, It will not be 3% like we saw a couple years ago, but will be much more in line with what makes sense and what's affordable, allowing more and more to get into real estate and making it much more affordable. But here's the real kicker. These rate cuts don't instantly flood the market with cheap money. It takes time for these effects to trickle down through the banking system and into your wallet. And don't be fooled into thinking that lower rates will immediately spike inflation. The economy doesn't work that way. During a recessionary period like the one we're navigating now, in my opinion, lower interest rates can actually stimulate economic activity without causing prices to skyrocket. Even with lower borrowing costs, if the general public is struggling to maintain, they will not rush to finance anything. If we were in a booming economy, I would 100% agree that it would drive up inflation and hurt mortgage interest rates inflation is the arch enemy of mortgage interest rates. But I don't know anybody speaking about how well the economy is doing right now, period. The economy isn't exactly firing on all cylinders, and that is seen on the economic data that comes out on a monthly, weekly basis. Now, if we see some sort of significant spike in M2, the total money supply, then we might have a different story. But even that takes time. There is a lag effect. A flood of new money could lead to inflationary pressures, putting those lower mortgage rates at risk. But remember, increasing the money supply and having it impact the economy takes time. It's not an overnight phenomenon. The fear of immediate inflation shouldn't keep you on the sidelines. Economic indicators suggest that inflation isn't poised to surge in the near term. The money from rate cuts is trickling into the system slowly, giving you a chance to act before the potential shift occurs. Now, what's coming next? Based on current expectations, the 10-year Treasury is poised to drop into the low threes, largely due to the ongoing economic concerns. And as discussed previously, the spread between the 10-year Treasury and mortgage rates is finally starting to normalize. That's why I believe we're going to see mortgage rates settle into the mid to high fives by the end of 2024, carrying into 2025, trending down into the low fives, and possibly seeing conventional interest rates starting at 4% by the end of 2025. Now, this isn't just a random guess. We're already seeing the pieces fall into place, with the 10-year Treasury likely trending down and with the spread between mortgage rates and Treasuries narrowing back towards more traditional levels. The math is pretty simple. Conventional mortgage rates are headed for a serious drop. Now, here's the kicker. These rates we've been talking about, they're all conventional interest rates. FHA and VA loans are even lower. We're seeing mid 4% rates for those loans right now in an FHA and VA. But if I'm right about what's coming, FHA and VA rates could dip into the high threes by the end of 2025. Just imagine the surge of buyers that would trigger. It's important to remember, of course, that nothing is guaranteed. But based on everything I've seen, I'm confident that my projections are on point. And while I cannot offer any sort of guarantees, well, I can guarantee this video. My name is Darin Hunter. Please like, comment, subscribe, and let's start a conversation. Have a great day.